Hello, welcome to this session wherein we'll be discussing IFRS 13 Fair Value Measurement. Let us start by first understanding the definition of fair value. So fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So there are four things that you need to remember about the definition. First, that it is a price that you would receive for selling. Second, it is an orderly transaction. Third, it is between market participants. And fourth, it is at the measurement date. IFRS 13 does not prescribe when to use the value, fair value, but it does tell you how to use it. For example, IFRS 13 does not tell you that you should value investment in non-current asset at fair value. It is IAS 40 which tells you that investments in non-current assets should be valued using fair value method. So, it has to be done in congruence with IFRS 13 while doing the fair value. The definition is based on the exit price rather than the entry price. That means an entity will use a price that is when they are selling the item and not when they are purchasing it. The other factors that you need to remember for fair valuation is that all the characteristics of the assets and liabilities that a market participant would consider should reflect in the fair value measurement. Example, the condition of the item, the location of the item. Also, the fair value should reflect the use to the market participants and not one specific entity. It is the use to the general market participants in the active market that should be considered while doing the fair value measurement and not what one single entity would use it for. Thirdly, the fair value should include the transportation cost as well because it is item specific. It reflects the characteristics, that is the location of the item, and therefore the transportation cost should be included while doing the fair value measurement. But the transaction cost should be excluded from the fair value because the transaction cost is a cost for entering into the transaction and it is not specific to the item. Thirdly, the scope of IFRS 13 excluded the share-based payment transactions. The other important definitions are an active market, a market in which transactions for the assets or liabilities take place with sufficient frequency and volume to provide you with pricing information on an ongoing basis, that is a continuous basis. The highest and the best use. The use of the non-financial asset by the market participants that would maximize the value of the asset should be considered, right? For example, if you have a plot of land on which there is a factory where the manufacturing takes place, but if the same plot is sold or developed into a residential property, the valuation would increase. So the valuation is highest or at its best when it is used for residential purpose. So that would be considered while doing the fair value measurement. The principal market. The market with the greatest volume and level of activity will be considered as the principal market. The most advantageous market. So the market that maximizes the fair value of the asset or minimizes the value of the liability after taking into consideration the transaction cost and the transportation cost into account. The point you need to remember here is to identify the most advantageous market, you will consider the transaction cost. But for measuring it at fair value, you will not consider the transaction cost. Look out for my next video where I have explained it using a practical question. Now, the highest and the best use, as I explained earlier, is the fair value measurement, which must reflect the highest and the best use of the asset, taking into consideration physical possibility, legally allowed, and financial feasibility. The hierarchy of inputs. Now, valuation techniques are used for valuing the items. One can use the market approach, the cost approach, or the income approach to estimate the price at which the asset or liability could exit from the entity in an orderly transaction. Now, the valuation technique requires use of inputs, which are categorized as level 1, level 2, or level 3. Let us have a look at these. Now, level 1 inputs are the quoted prices in an active market for identical assets or liabilities which the entity can access at the measurement date. For example, share market, where the shares of listed companies are traded, right? So, the prices of the shares are quoted, and the shares of XYZ Limited, for example, are all identical. So, if you get the quoted price for one share, that could be the value of the shares that you hold. So, these are observable units from active markets. So, these are quoted prices. Level 2 is inputs which are other than the quoted prices that are observable. Quoted prices of similar assets in a less active market, or similar assets in an active market, or identical assets in a less active market. For example, in an housing society which has 10 high-rise buildings, the apartments on different floors, the floor plan might be identical, but these apartments are not identical because the floor level will differ. The location, as in east facing, west facing, south facing, may differ. In that case, you will have to adjust the valuation based on these adjustments, or the locations, you can say, which are item specific. So here, to some extent, you are using your judgment. You are comparing it with similar assets in an active market, right? Now, the third level is inputs which are unobservable. There is nothing to compare it with, and you have to use your judgment, experience to arrive or to do the fair value measurement. So, the third level inputs involve high degree of subjectivity. Look out for my next video for some practical questions or applications of IFRS 13 fair value measurement. Thank you.